Hello, everyone. I'm David J. Barilli, a manager in our restructuring and insolvency division here at William Buck.
And I'm Nick Marachi, principal here in the tax services team.
And today I'm going to be talking a little bit about deeds of company arrangement. So before I get into the actual DOCA process for short, I might discuss a little bit about the precursor to any DOCA, which is the voluntary administration regime. Now, voluntary administration, or VA, is a process designed to give companies some breathing space from their creditors. It allows an independent administrator to assess the future viability of a company and explore options for its continuation. Now, there's three outcomes to any voluntary administration process. The first being that control of the company is returned to the directors. Now, this is rare as it usually doesn't actually address the solvency concerns being experienced by the company. The second option is that the company enters liquidation. That's if there's no will or hope for the continuation of the business or its survival. And the third and final option is that the company executes a deed of company arrangement, or a DOCA, with its creditors. So what is a DOCA? Essentially, a DOCA is a formal framework for a company in VA to restructure its affairs, be that balance sheet, whether it's its workforce, its unprofitable contracts or operations, and actually compromise or repay its debts. It can be over time or upfront, as well as allowing it an opportunity to continue its operations and offer an alternative to immediate liquidation. A DOCA is a formal agreement between a company and its creditors, and it also involves other relevant third parties, such as secured creditors like banks or financiers. A DOCA sets out the terms and conditions which a company needs to abide by in managing its creditors, and it also sets out the extent and nature of the company's obligations under the formal binding agreement. So, what is the main purpose of a DOCA? There are two main purposes. I feel like we've lost. Oh, we're here. Sorry. We're up there. I forgot.
You'd see if it's still working.
No, it's working. It's working. All right, let's start again. So, what is the main purpose of a DOCA? There are two main purposes which underline the actual DOCA process itself. The first primary purpose is that it maximizes the chances of a company's survival and it returning to solvency so it can continue operating. The rationale being that any DOCA will address the solvency issues underlying the company's problems and allow it to reset and start again with a clean slate. It also needs to provide a better return to creditors than an immediate liquidation. An immediate liquidation is often an Armageddon-style situation. You have a fire sale scenario of assets which significantly compromises asset prices and goodwill. It's important to note that the underlying objectives of the DOCA need to be upheld, because where a DOCA doesn't serve the interests of creditors, where it aims to deny the process of liquidation on purpose, or where it does not actually contemplate continuation of a business or trading, there is a risk that an aggrieved creditor or stakeholder could apply to have the DOCA set aside or terminated by the court.
So, DJ, what are some of the advantages of DOCAs?
I'm glad you asked, Nick. There's many benefits, as you'll see up on the screen. Firstly, it has the potential to bind all creditors of the company under its terms. It allows for a degree of flexibility, and what I mean by that is you can actually structure DOCA repayments as either lump sum payments, you can have installment arrangements over time, or you can also arrange to have payments made from percentage of future trading profits. It offers a company an avenue to be released from its debts as at the date of appointment of the administrator, and that's provided that the terms of the DOCA are complied with overall. It also allows the control of the company to ordinarily revert back to the director if they're the ones proposing the DOCA in either a full or limited capacity. And it provides for a moratorium on creditor recovery action, which means essentially that a creditor cannot commence or continue legal proceedings against the company without the leave of the court whilst that DOCA/voluntary administration process is under effect. The DOCA regime also enables a company to successfully restore itself back to solvency, i.e. cleaning its balance sheet up and cleaning up the liability section of its balance sheet. And it provides for often the best outcome for stakeholders, as it enables the business to have continuity of its actual trading and maintain those ongoing relationships with its suppliers, its employees get to keep their jobs, and often, especially in the case of larger listed entities, shareholders get to retain some of their value. Importantly, it'll likely provide a greater return to creditors than an immediate liquidation in most scenarios, if accepted by creditors. And it can often provide an actually a quicker or relatively quicker. It can actually also be relatively quicker in certain circumstances in providing a dividend or distribution of assets back to creditors. So I've developed a little case study for our audience today, which hopefully resonates a little bit. We've got White Goodman, who's the sole director of Globo Gym, an upmarket inner city fitness studio based in Melbourne. Now, Globo Gym was forced to shut its doors for an extended period during COVID, and this has led to a significant accumulation of tax debt. Globo Gym has actually struggled to get on top of its ATO debt with rising interest rates, slowed foot traffic in the CBD, reducing its overall profitability. Globo Gym actually employs over 50 staff and has a large community of prepaid club members who are generally supportive of the business. They've got a great community base. And White is actually concerned for the future viability of the business. In particular, he's quite worried that the gym will be forced to shut its doors and have a sale of all its plant and equipment in a liquidation scenario. That's me. Okay. So Nick, just touching on or having a think about all of the benefits of a DOCA that I mentioned earlier, how do you think a DOCA might actually benefit Globo Gym in this situation?
Well, you did mention it was binding on creditors.
That's a great point. So in my opinion, I think Globo Gym is actually a key candidate for a DOCA in this situation, as it has a profitable business with a general historical debt build-up from the ATO, which could actually be compromised through the DOCA process and restore it to solvency overall. As you mentioned, the DOCA is binding on all creditors. So although the ATO being the major creditor, although they might not agree with the DOCA, if you've got overwhelming support from your creditor base, such as your prepaid members, this might actually allow the DOCA to pass through, but I will touch a bit more on that later. The DOCA situation will also maximise the return to creditors. As I mentioned, in a liquidation, it's probably going to be a fire sale of that plant and equipment, and that's unlikely to maximise the value of the business and provide the actual best return to creditors. So, I suppose next I'll speak about the situation of how a company goes in or enters a DOCA. If an administrator does consider that a DOCA is a viable option for a company, they'll work closely with the proponent of the deed, that is the person proposing the deed, which can often be the director or a third party, such as a secured creditor like a bank. And they'll look to prepare the proposal and set out how the company's affairs are going to be dealt with. Administrators are required to prepare a report to creditors in the lead up to this, in the lead up to a meeting of creditors, in which it'll outline their recommendation for the future of the company. And the creditors will then be given an opportunity at this meeting to vote on what the future of the company looks like. Now, in order to pass a resolution at one of these meetings, as you can see up on the slide, there's a few methods by which the determination is actually met. Firstly, you need to get a majority of the number of creditors in the room voting to pass the proposal of the DOCA. In some instances, if there's a large, I suppose, creditor base by value, they might request what's called a poll vote. In that situation, you need to have a majority of the number of creditors and a majority in the value of creditors voting on the day. If there comes a situation where these two, I suppose, voting options are clashing, and you've got one in number and majority in value as well, the administrator then gets what's called a casting vote, and they actually get the opportunity to break the deadlock and decide what the future of the company looks like. And generally, that would be cast in the same vein as the recommendation that's outlined in their report to creditors. So, I mean, going back to my earlier comment regarding the administrator's report, as you can see up on the screen, I've got a little sort of summarized version of what a typical estimated return analysis, which would be included in an administrator's report, would look like. It clearly weighs up the expected cents in the dollar return for creditors in both a DOCA versus a liquidation scenario, which are the two outcomes of that second meeting of creditors. As I mentioned earlier, in an immediate liquidation scenario, you've got Globogym's asset value is compromised significantly compared to what's up for grabs in the Docker scenario, where perhaps the company is actually continuing to trade, and you might have a going concern sale in play or new capital coming into the business. And also included in those available resources up in this liquidation scenario would be an estimate for any insolvent trading or voidable transaction claims. And it's important to note that because these recovery actions only become available in a liquidation scenario. So it's important that creditors weigh up whether those actions might yield a better dividend than what is likely to happen in a Docker scenario before they make that determination on the vote. So what does a Docker cover overall? It's usually a lengthy agreement with a whole heap of clauses, which are quite difficult to follow. But in a nutshell, I've summarized them as best I can here. Firstly, we've got who is to be appointed the deed administrator. The Docker will usually outline what the powers of that person or persons who are responsible for overseeing the company's affairs during the Docker period, whilst the Docker is in effect as well. As I mentioned earlier, there's a moratorium on legal action, which is usually included in the Docker itself, which will allow that breathing space and suspend legal action whilst the company tries to effectuate their restructuring process. An administrator can also implement what's known as a holding Docker, which provides creditors or a proponent with more time to develop a proposal, given that the administration period is a relatively short, sharp period of time to develop a restructuring proposal. This protection, however, doesn't, or the moratorium, however, doesn't extend to personal guarantees that are agreed to by directors during this period. So it's important to note that for any directors considering a Docker. The Docker will also often look at the priority of creditors in any distribution scenario. So that's the treatment of the different creditor groups. It will likely distinguish between the different classes of creditors and the priority of those payments, i.e. you've got your employees, your secured creditors, and your unsecured creditors at a basic form. I suppose generally you've got administrators are quite, start again. Generally, administrators are bound by the priorities set out in the Corporations Act about how funds will be distributed in that priority, with the golden rule that any Docker must ensure that the employee entitlements are paid first before, or at least if it's not going to be that way, they need to get consent of the employees to alter that priority. We've seen a trend of some practitioners trying to implement tiered Dockers, which distinguish between different batches of unsecured creditors, for example. However, given the statutory priorities are quite prescript, we do anticipate that these might get challenged in court over the short term. So we'll wait and see how that plays out. You've also got the Docker outlining how the payment arrangement or the distribution of funds will work as a matter of process. A Docker usually sets out the proposed arrangement for a company's debts. Like I mentioned, you've got your lump sums or your repayment plans or your trading profit plans, as well as the method and timing of which those monies will be distributed. It'll outline how the business is to be restructured and the strategies for the company's financial and operational restructuring, as well as having some clauses in there about what might happen in the case where the Docker needs to terminate, or how it will complete and what the milestones we need to reach in order to get the Docker actually fully effectuated and get the company back on its own two legs.
So DJ, can you give us a quick rundown of the Docker process?
Sure can, Nick. So in a nutshell and very briefly, creditors will vote on the Docker at that second meeting of creditors, as I mentioned earlier. Once that vote is complete and permitting that the Docker is approved by creditors, the deed proponent and the administrators will then have a maximum of 15 business days to actually sign the document itself, which is a relatively short turnaround given the size of the proposal, but you'd hope you're quite well advanced by that point. The deed administrator will then monitor the Docker's compliance, that is making sure the payments are coming in on time and any other obligations that are written into that contract. And then once we come to a point where we've got sufficient funds available for creditors, the deed administrator will then review and adjudicate all the claims submitted by the creditors via what we call a proof of debt. And then once those claims have been admitted for that purpose, they will distribute these funds and the DOCA can hopefully be effectuated in full. If these milestones aren't met, then we've got the situation where the DOCA might need to be terminated and the company would enter liquidation. So I suppose DOCAs can come in many different various. So DOCAs can come in many different and various forms and provide a number of options for distressed businesses to survive. I've got a couple of restructuring options listed up on the slide. The first being repayment plans. So this essentially provides the business with time to repay its creditors whilst revamping its working capital. You've also got the trade sale option of the sale of the business, which allows for new management. It could be competitors who are interested in taking a share in the business to take actually ownership and purchase the business or its core assets whilst retaining any of its employees or its IP, which will overall retain the maximum value and get the maximum value out of the business in a going concern scenario, rather than in that piecemeal sort of plant and equipment sale option scenario. You've got recapitalization options, which can come in a few forms, which provides for new capital to be being injected within the actual business without that burden of historical debt on the balance sheet, which is obviously being cleaned up by the DOCA process. This overall provides a level of comfort for new investors that their investment is going to be wasted cash flow or working capital. And finally, one we've done in the past is debt for equity swaps. Now, this allows stakeholders to take an equity stake in the business in exchange for conversion of its debt. It's particularly useful for secured creditors such as banks or lenders who might be willing to compromise or cooperate their large debt holdings for a stake in the business, which will ensure its ongoing viability and hopefully limit its losses overall. It's also very effective for your large listed entities who have extensive shareholding registers. If creditors and shareholders are provided with return in lieu of cash in the form of shares, for example, this, although diluting shareholders' holdings, allows them to preserve some of the value in its shareholdings rather than render them worthless and enter liquidation. In our time, we've seen, I suppose, the ATO is often a major creditor in most administration situations, and they've got I suppose, their own view of DOCAs and how they might approach them. We've listed out, I suppose, a number of factors which we've seen and which the ATO have expressed interest in considering whenever they consider whether to approve or deny a DOCA. The first being that they need to make sure that the arrangements in place are there to meet future tax liabilities. They want to see what the compliance history of the debtor and its related parties are, which is quite important. They also want to see what the likelihood that the proposal is that it can be achieved, and it's not just a pie in the sky sort of operation or proposal. They want to look at what potential voidable transaction or insolvent trading disposition claims are available in a liquidation scenario. Remember, I mentioned that those sorts of claims are only available in liquidation. So the ATO wants to know they aren't foregoing a substantial claim in lieu of accepting a DOCA proposal. They'll also be very interested in the priorities to be distributed under the DOCA and making sure that, I suppose, they're not prejudiced. And that, I suppose, also links to the last point in the sense that they want to know that creditors aren't being unfairly prejudiced, or the DOCA isn't discriminatory in some way against certain creditors and not others. In our experience, the ATO will often reject a DOCA proposal as a matter of internal policy, but we have seen instances where they see a potential benefit to be had and will accept the actual proposal. It's also important just to touch on director penalty notices, which are a specific tool used by the ATO as of recent times to make directors liable for particular outstanding ATO debts. In our experience, the ATO considers that director penalty notice debts such as superannuation guarantee and PAYG as parallel liabilities. Now that means that although a company might go through a DOCA, they still consider that the debt would be owed by a director if they've issued a director penalty notice prior to. So this is why it's important to ensure that all a company's lodgements are submitted on time and consistently. in order to make sure that essentially the directors are protected from future director penalty notices being issued even after a DOCA is completed. So just rounding out, a few key takeaways for our audience in terms of dealing with DOCAs. Firstly, I think it's safe to say that prime candidates for a DOCA include those businesses with profitable underlying business operations, perhaps an accumulation of historical debt such as taxation or revenue office debt, and a genuine will to continue trading into the future, because that's obviously critical for the underlying purpose that the business does actually continue and isn't just doing this to, I suppose, avoid liquidation. DOCAs will sometimes often benefit creditors. DOCAs will also often benefit directors and some trade creditors in the situations where insolvent trading claims or potential avoidable transactions such as preferences dissipate, given that a DOCA is accepted. However, this overall won't prevent the actual enforcement of personal guarantees against directors. I think the final point is that creditors will need to often weigh up the estimated return in a DOCA and a liquidation scenario, and that's where the second report to creditors of the administrators is quite useful. Overall, that's going to be the key determining factor for a lot of creditors as to whether they accept a DOCA proposal. That's really it from me, Nick. So thank you all to our audience, and hopefully this has been very useful for you. If you do have any questions, please reach out to our office to discuss. Thank you.
Thank you. You put a disclaimer up.